You crossed it. The number you've been engineering your entire career toward. $1 million. And instead of freedom, you feel nothing. Worse than nothing. You feel a low-grade persistent panic that you are absolutely not allowed to say out loud. Because what are you supposed to say? That you've hit a milestone that less than 10% of Americans ever reach. And it still doesn't feel like enough? That the relief you promised yourself, the one that was supposed to arrive with the wire confirmation, never came? This isn't a psychology problem. It's not ingratitude. It's not imposter syndrome misfiring. It is a math problem. And the math was always stacked against you. The traditional wealth accumulation model, the one sold to every high-earning professional from her first corporate orientation, was not designed to give you freedom at $1 million. It was designed to lock your capital into structures that are legally, contractually, and institutionally inaccessible to you. During the exact decades you actually need liquidity. And here is the moment nobody tells you about. The moment you hit $1 million in net worth and realize the system counted your money before you ever could. Let's run the actual architecture of a standard millionaire's balance sheet. Not a hypothetical one. A realistic one. Belonging to a 38-year-old female VP at a financial services firm in Chicago or San Francisco, earning $185,000 base plus a $40,000 performance bonus. Here is where her $1 million actually lives. Approximately $420,000 is sitting inside a 401k. It is technically hers. But access before age 59.5 triggers a 10% early withdrawal penalty plus ordinary income tax, which, at her bracket, means the IRS claims roughly 32% to 37% of every dollar she touches early. That $420,000 is not liquid capital. It is a future promissory note she cannot cash. Without a structural penalty engineered to discourage her from doing exactly that. Another $390,000 is embedded in primary home equity in a high-cost metro market. It exists on paper. But equity is not income. Equity does not pay her mortgage, her property tax, her $4,200 per month childcare, or the cost of the executive wardrobe that is a non-negotiable professional requirement in her industry. To access it, she must either sell the asset or take on debt against it. Neither of which represents freedom. That leaves her with approximately $190,000 in truly liquid, taxable brokerage and savings assets. Against her current annual burn rate, housing, taxes, dependent care, insurance, and baseline lifestyle costs in a high cost of living city. That is less than 14 months of genuine runway. 14 months. That is the actual freedom her $1 million net worth buys her. She is not broke. But she is illiquid in a way that is functionally indistinguishable from broke. When she's sitting across from a board that's restructuring her division, this is not a personal failure. This is the structural output of a wealth model that was calibrated for a 1985 male employee who owned a modest suburban home, had a single-income household, and planned to retire at age 65 in a low-cost zip code. That employee and this woman share almost no financial reality, but they were handed identical financial playbooks. Here is the mechanism nobody names directly. A 401k contribution reduces your taxable income today, which feels like a win, but it simultaneously reduces your accessible capital base. Every dollar you optimize for tax deferral is a dollar removed from your liquidity architecture. The tax system creates an incentive structure that quietly trades your present-day financial autonomy for a future state tax arbitrage. And if your life circumstances require capital access before age 59.5, a career transition, a health event, a business opportunity, you are penalized for touching your own money. The system didn't build a trap. It built an incentive. But for high-earning women in high-cost metros, carrying the full weight of household financial responsibility, that incentive functions identically to a trap. She hit $1 million and discovered that 90% of it was behind locked institutional doors. The burnout didn't arrive because she was ungrateful. It arrived because she finally did the actual math. So what does real financial freedom actually require at her income level and geographic reality? To fully replace a $225,000 total compensation package using passive or semi-passive income, without touching tax-deferred accounts, requires a liquid income-generating asset base producing approximately a 4% to 5% annual yield. At 4%, that number is $5,625,000 in deployable capital. At 5%, it is $4,500,000. She has $190,000 of it. This is what I call the liquidity mirage. The precise moment a high net worth milestone is reached. The milestone feels real, but the underlying capital architecture reveals itself as structurally insolvent for the specific type of freedom the individual was pursuing. The number is real. The freedom it was supposed to represent was always a projection, built on a model that never accounted for her actual cost structure. The institutional-grade correction is not to stop contributing to tax-deferred accounts. It is to run a parallel capital track, a deliberately structured taxable investment portfolio designed to generate accessible income before retirement age, not after. The strategy is called a non-qualified liquidity bridge, a taxable brokerage account built alongside retirement contributions, invested in dividend-producing assets, tax-efficient index structures, or real estate investment trusts generating quarterly distributions. Every dollar in this bridge is accessible without penalty. It builds the runway she actually needs, not the runway the 1985 playbook promised. Her retirement accounts build long-term wealth. Her liquidity bridge buys her the option to walk away from a toxic board, take a calculated career risk, or simply breathe without a penalty notice from the IRS. The $1 million milestone isn't the problem. The single-track capital strategy that got her there is. The liquidity mirage doesn't operate in isolation. The locked-up retirement capital that is making her millionaire milestone feel hollow was built by following instructions, specifically the standard industry-endorsed retirement advice handed to her at age 24. By every financial planning framework, employer orientation deck, and personal finance bestseller on the market. That advice told her to maximize, defer, be patient, trust the timeline, and that advice, mathematically, may have already cost her the highest leverage decade of her financial life. By directing every available dollar into accounts she cannot touch until age 59 and a half. While her peak earning, peak investing, and peak compounding window is happening right now, between age 30 and age 45. The mechanics of how standard retirement advice was engineered to serve institutional interests, not her liquidity, not her autonomy, not her actual timeline, are operating inside her portfolio at this exact moment. Click the video on your screen right now, and let's pull back the next layer to dissect how the retirement advice industry systematically redirected your highest earning years into structures that benefit fund managers long before they ever benefit you.